Again, as I mentioned, I'm host of the Money Mindset Mastery. Joining us today, we have Eric. Eric, can you maybe provide a bit of background?
Hey there, Jim. Yeah, I'm Eric at TVH. I'm the private wealth advisor. My area of expertise is investments that focus in private equity. Yeah, that's me in a nutshell.
Usually we have our portfolio manager, Denis Bizon, joining us, but he's a little bit under the weather. And then we did have Ryan. He disappeared, so we'll maybe bring him back in afterwards. But we also do have our special guest, Jon Sowerby, who is partner at TVH Group, mortgage broker at Verico TVH Mortgages. Jon, maybe you can provide a bit of background as well.
I'm a mortgage broker at TVH Mortgages, a partner in the firm.
Right.
30 years of financial professional, or at least pretty darn close to, and a chance to revisit my roots today, because I started out on the trading floor on Bay Street in money market and currency, and a lot of that is going to factor into the points that I make this afternoon.
Awesome. Well, thanks for joining us. And Ryan, you reconnected again, so maybe you can provide your background.
Just coming back from vacation, so excited to be back as always. And I know everybody missed me from the last version. But ultimately, I help with cash flow and understanding people from day to day, and making sure that people really are educated when it comes to understanding buying their next home and making sure that they're having enough money for the next investments, and then helping support TVH Financial as a whole is part of my job. So
right. Well, today's topic, and we have a lot of people that have registered for today's topic, so I think it's top of mind for a lot of people. We're talking about to fix or not to fix. So we're going to talk about rates and gas prices, your mortgage, and maybe the shaky economy as well. And this kind of was from an article, or not an article, an email, Jon, that you sent out just 7 days ago on something that happened the Friday before then. So I'm just going to kind of go through some of this here. The title of your email, which caught my attention, was "Friday was a bad day for borrowers." So I think we want to talk about why Friday was a bad day for borrowers, and is it still a bad day today for borrowers, or have things gotten better, have things gotten worse? A lot of it is based on the conflict in Iran. 4 years ago, a lot of it was due to Russia attacking the Ukraine. So now we're dealing with another war, and kind of some similarities. There was an oil shock 4 years ago. There's a bit of an oil shock right now. Gas prices, inflation was a big concern. Bond yield spike. Well, actually, I don't know, Jon, was there a bond yield spike 4 years ago, or was that more Bank of Canada rates that were kind of spiking?
We saw the bond yield spike. I think we actually might want to take just a quick step back from that to where we were probably late 2021. Yeah. So, we'd been a year, the better part of 18 months into COVID. We had been making progress on vaccines. There was still some road to hoe, but I think by and large, there was some very cautious optimism. And the term at the time surrounding inflation, which ultimately became the big issue in 2022, was that it was transitory. And I think, in fairness to Tiff Macklem, the governor of the Bank of Canada at the time, and the current governor, if we didn't have the hostilities break out in Ukraine, that may well have been the case. I think we were essentially teetering on a knife's edge at that point. We definitely seen inflation spike as a result of low rates, but a good chance that things might have settled, because a lot of that was structural, a lot of that was pipeline orientated. I don't necessarily mean oil, but the service routes, the way that we had integrated systems for moving products around the globe, et cetera. I think all of us became minor economists at the time when we saw the Russian tanks roll in, and all of a sudden figured out that 10.1% of all grain exports worldwide came from Ukraine, and what that meant to us. So up until that point, we probably could have gotten away with things. And the problem is, I think in an attempt to engineer a soft landing, Governor Macklem avoided any sort of attempt to arrest inflation with higher rates in 2021. Unfortunately, fast forward to February 2022, things started to go very badly wrong for inflation. It started to become clear that it was much more than transitory. And then rather than pumping the brakes into the stop sign, he had to hit the brakes hard. Right. And that's where things got bad. Now, there are some similarities, but the way it works is, although there is generally a correlation between fixed and variable rates, it is not exact. Right. So you might have fixed rates move more quickly than variable rates might move more quickly than fixed rates. You may have a spread that can widen out. So sometimes you might have variable rates that are higher than fixed rates. That's not the norm. But sometimes you can have fixed rates as much as a couple of hundred basis points, so 2 full percentage points higher than variable rates. Again, not the norm. But at any given short-term period, you might see those kind of distortions depending on what is happening. And the reason for that, and part of the reason why the spike in bonds caught my attention, is because the bond market ultimately is a free market. There is, beyond the fact that people are trading, there is no specific government interventionism on a given day. Whereas with the variable rates, that is typically based on the money market. And the trick there is, in addition to sort of whatever the market is doing, you also sort of have the governor of the Bank of Canada coming out and waving their magic wand and saying today rates are magically higher or lower, depending on whatever their reasoning may be. So as a result, while we haven't seen a lot of movement on variable rates, we have seen a bit of a spike in fixed rates. And anytime you have that much of a jump, it's the sort of thing that I watch for specifically. And I sent out that little missive to make sure that people were aware.
Right. And of course, timing is incredible because what is it in terms of percentages of people that are renewing, their mortgages are renewing this year? Is it like a record amount of renewals that are happening? And up until about like June as well, like this is all, the timing of it all isn't really ideal, is it?
So the suggestion is that approximately 60% of all renewals would essentially hit the market over the 2025 and 2026 year. And that's a direct causal link from 2020 and 2021, where we had some real booming real estate markets as a result of very, very low interest rates where the money supply was functionally expanded. Mm-hmm. And as a result, in Canada, the overwhelmingly most popular term is a 5-year fixed term. And what we see is people coming up at their renewal. And so we have, as a result of that boom back in 2020 and 2021, we have a fairly large rollover in 2025 and 2026.
Right. And 4 years ago, just to remind me again, was it the fixed rates were lower than the variable because of the Bank of Canada increasing their short-term rates?
The way it worked is we had some big drops right at the beginning of COVID in March and April of 2020. They brought rates down 1.5%, got it almost to zero on what they call the overnight rate, which is the interbank lending rate. That's the money that's loaned between the Bank of Canada and essentially the big banks in Canada.
And that historically was like very low.
A quarter of a percent, so 0.25%. You're almost at zero, so about as low as you can go.
So great for borrowers, but for people who are putting money in savings accounts who are only getting like 0.15% or barely getting 1% on a GIC, like it was horrible for them, but great for people with debt.
Exactly. Yeah. And so what we saw was as that took hold, because in fairness, there was a lot of uncertainty. The government wasn't sure what was going to happen. This is something we hadn't seen in a century. Mm-hmm. So the reaction was swift and frankly, quite decisive. Mm-hmm. That was not Tiff Macklem. That was his predecessor who made those cuts. And then, things took off from there. I think where Mr. Macklem has been careful this go around is, I think he recognizes that if he had, 2021 back, he might have started some very gentle rate increases at the time. Right. And again, I'm not a huge fan of Mr. Macklem's, but
Right.
I think in fairness, I will defend him on this point. I don't think anyone saw a land war in Central Europe coming, at the time that he decided to not raise rates. That really was something that upset the apple cart. And similarly today, we had a theory that based on general economic weakness in Canada, rates were going to continue declining, and we had started to see that after a bit of volatility in sort of middle 2025, that as of about Q4, there was a decidedly declining level on the bond market. There was some feeling we would see another couple of rate cuts middle of this year, very possibly around the CUSMA negotiations. I think it's fair to say that the Canada, US, Mexico Free Trade Agreement negotiations, there's probably not a lot of optimism from a Canadian perspective. And I think the Bank of Canada wanted to keep perhaps a rate cut or two in their back pocket just in case things got bad. But when the bombs started falling, I think it was February 28th, we saw that trend start to reverse. And then I think it was, like we said, a couple of Fridays ago, where they started to suggest they were moving, I think, a series of ground troops into position. That's when we saw the spike.
Right. Yeah, that's a lot going on, and I do want to talk a little bit about kind of where we're at with inflation now, some of the recent numbers, because a little bit different than 4 years ago, right? Like inflation about 1.8%, and maybe you can talk to why maybe it's artificially on the lower side, and then the Bank of Canada rate right now is currently at 2.25%, and there's definitely discussions, I'm hearing them from everyone as well. Some are predicting 3 interest rate increases this year. I've heard others where things are going to stay as they are, and I've heard a few suggest that maybe there'll be a couple of rate cuts as well. So maybe you can speak to all those 3 points.
So we've got a couple, 3 points then, so I'll probably ask you to remind me. But the first point was to speak to
the 1.8% inflation rate, which I believe it's artificially on the lower end.
So the expectation was 1.9%, came in at 1.8%. A big reason for that is probably because there is overall economic weakness, and the fact of the matter is people just tend not to spend as much when they're concerned about their jobs, their livelihoods, whatever you want to say. Yep. In terms of artificially low, what I would say is there are certain core components of inflation that the Bank of Canada watches very carefully. So, for example, food is something that has bucked that trend a little bit. It's probably typically come in a little bit higher. But the reality is we've had a fairly significant decrease for a number of people in the cost of housing, for better or for worse. That's a pretty big component. As I disagreed with using things like interest rates on the way up, because I think in many respects, higher interest rates are in fact a tool for sort of anti-inflationary devices with regard to the Bank of Canada. So too, it probably holds with the individual household. If more of your disposable income is going towards covering your interest payments on a given month, whether it's credit card, line of credit, or mortgage, you're probably not spending as much. Right. And I think there's probably something to be said here as well. In terms of whether or not that's artificially low, I think my point of view on that is the reason they take a basket of goods for inflation, just so that our listeners understand what that means, you take what the cost of a loaf of bread is, and you take what the cost of a quart of milk is, and a stick of butter, and so on, and you bundle that all together along with things like housing, gasoline, and you try to get a bit of a cross section. Mm-hmm. So what I will say is, artificially low is maybe a bridge too far for me to go, because I will say other things are pulling back. And so I think the inflation is probably a little bit softer overall, but I would say the Bank of Canada is well aware of the component pieces, and what they have been doing is they've just been watching those very carefully. So just because inflation came in a little bit lower than expected last month, if we can take that in a vacuum away from the Iran conflict, the reality is the Bank of Canada would have probably still been loath to lower rates at that stage, but it does seem like that might cut both ways. And one of the things we'll talk about a little bit later is the Bank of Canada sort of similarly looking at sort of the current situation and saying, until we know that this gas crunch, this oil crunch is going to be a little bit more entrenched, we're also not necessarily in a rush to raise rates either, because they've got a pretty tricky path in front of them. And again, we'll dig into that in a bit, but I think that was point one. What was the second question?
Well, before I get into point two, so the reason why I said artificially low was because there was the tax holidays on certain foods last year from December to and ended at the end of February. So when you're looking at February to February numbers, it actually included that tax holiday, and that's where we're hearing that inflation is showing to be lower than it probably really is because of that tax holiday on the food during that period of time. So I think we're going to get a better or more realistic number end of March, end of April. Right?
And that's fair, but all I would say is recognize the 1.8% that we hit was against the target number that most economists and consensus agreed on at 1.9%.
Right.
And I am sure they were factoring that in when they made their consensus choices.
Right. Okay. And before I remind you of the second question, I want to remind everybody as well that anything we talk about today should not be taken as any kind of advice or, a way for you to take as advice. I'll repeat that again. Sorry. But if you do want some advice on what you should do with your mortgage and with your debt, then we ask you to reach out to a qualified advisor like Jon. So Jon can help you with answering any of those questions and kind of reviewing your specific situation, similar to Ryan, Eric, or myself as well. And then finally, for the people that are on live right now, you can ask us questions through the chat window. So if you just go in through the chat window, there is a Q&A section where you can ask us questions live. And if you're watching this on one of the social media platforms that's live streaming, you can also put some questions in there as well. So the second one was the Bank of Canada rate. Right now it's 2.25%. Again, I've heard from some people suggesting that there's going to be 3 increases by the end of the year. I've heard others that have said, no, things are probably going to stay at the 2.25 and we're not moving off of that. And I've heard maybe a small minority of experts suggest that we might actually see 1 or 2 drops in the rate. So, you have a finance degree, you worked on the trading floor for one of the big banks. You probably have that crystal ball from Amazon as well on your desk. So what do you think we can expect from the Bank of Canada?
So again, and there's economics, and then there's sort of the psychological economics. And I feel like sometimes it's like they say with poker, you don't necessarily play the game, you play the person across from you.
Right.
I feel like Mr. Macklem, the governor of the Bank of Canada, is the sort of fellow who wants to look back and have people say he had no choice. There have been some central bankers, and I think by and large in Canada, we've been a little bit spoiled. We've had some pretty fantastic central bankers, and a lot of them, understood when to sort of step in and try to lead the markets, how they might sort of address potential issues, potential change. And what I would say is he is the kind of guy who I think wants history to look back and say, well, again, what else could he have done? So I don't hold out a lot of hope that he's going to go hard to one side or the other and make the call. I think he's in a tough spot. He sees what's happening with jobs. He sees what's happening with GDP. He sees the structural change happening with the states and the potential for, a degradation of our interaction and interconnection with them. And he sees downside risk. Now, the usual play for a central banker, if there's downside risk, is to reduce rates, stimulate the economy. However, he is also very aware of the inflationary potential. This is why I say, to an extent, that the time in Iran is, I think, a big thing. So we recognize that it probably doesn't make a lot of sense for President Trump, based on what he campaigned on and based on the feedback he's getting, not just from Democrats, but also members within his own party, that he doesn't want an extended conflict.
Right.
I also recognize that although he has moved Trump's people and troops into the area and has seen a military buildup, I think the path to peace is often sort of carved with, a strong showing. And so I think that may be the potential sort of game that he's playing. He wants to show a strong hand in order to try and broker a better deal. That doesn't sound unreasonable based on what we've seen on sort of the first, year and change that he's been in office. However, if it does turn into a situation where boots are on the ground, then all bets may well be off. Now,
Right.
That being said, this brought me back to something, and I recognize this saying predates my time on the trading floor, which was sort of the late 90s. But you buy the rumor and you sell the fact.
Right.
So I read a lot about these kind of things on a regular basis just because it is a genuine interest for me. And one of the things that I've noted in our current circumstances relative to, say, the oil crunch of the 70s is a lot more countries produce a lot more oil than they used to. The relative significance of the Middle East in terms of the oil trade is not what it once was, which is not to say it's still not significant. But even a detail that I picked up on the weekend as I was reading through some of the breakdowns of what was going on, the Saudis built a pipeline which funnels somewhere between 5 and 7 million of oil barrels a day. I think the Strait of Hormuz typically flows something like 15 million barrels a day, which is roughly 20% of global oil. The Saudis have started to cycle up, not surprisingly, their ability to move their product because they are particularly, stuck with regard to getting oil out. And that is a contingency that they obviously, planned and built many, many years ago. It's not something they started a month or two ago when this kicked off. Right. So the states, I remember seeing a breakdown of approximate oil reserves with shale and fracking and whatnot. There is a lot more available oil, whether it's the oil sands, the United States, et cetera. So North America actually seems to hold as much oil as the Middle East. Now, there are some issues around how we get that to market from Canada, for example. I know that's a sort of a current discussion at the political levels. But the bottom line is we're probably not as dependent as we used to be. However, that doesn't mean there isn't the opportunity for various groups out there who potentially benefit from a high oil price from going out and turning the screws a bit and seeing what they can do to try and move things along. I still remember, one of my days trading back in the late 90s where I was dealing with a number of folks out on the oil patch in Alberta. And I remember a fella saying, if we could just get to $16 a barrel, John,
Right.
and be I think we were at $8 a barrel at the time. So, fast forward today at $100, and you don't have to run too long before all of a sudden, some petro companies do really, really well on the bottom line. And again, I'm not saying that they're necessarily pushing that, but I don't think they're fighting that too hard because I certainly haven't heard a lot of the narrative of, hey, oil's a lot more accessible than it used to be. Now, it's also not easy given Russia is the major provider. Obviously, people are trying to wean themselves off of that oil. There's absolutely a level of volatility. But again, buy the rumor, sell the fact. I think that as things progress, we may become more aware of some of these alternates that have been put in place over the last few decades to address exactly this kind of situation. So
I remember
but the long term we'll see.
Yeah, I remember, I think it was June of '07 when oil was kind of approaching 150 US a barrel, and they were predicting back then 200, and it's because a lot of so-called experts had indicated that by 2020 we'd completely run out of oil. We'd have no oil, and then we'd be in big trouble, right? And clearly we still have oil and, and an abundance of it. So I just question these so-called experts sometimes.
Well, you can guess the information you have, but I still remember an Economist article I read back, I think it was the year 2000, and they talked about oil reserves, and they said in 1980, we were using 4% of known oil reserves. So that means if you stay at that pace, 25 years you're out of oil.
Right.
And by 2000, we were using 2% of all known oil reserves. And again, technological advances, the ability to get it out of the ground in a more efficient manner, et cetera. So you've got to take those kind of predictions about the future with a bit of a grain of salt.
Yeah, for sure. So you've shared a lot of information. The one thing I don't think we really talked about specifically is what happened on that Friday.
So really, the bit of a perfect storm. I think that
Yep.
was the first word that we got that I can't remember the name of the task force, but a Marine task force was moving into position with regard to troops.
Yep.
We also had a couple of banks come out with reports on, what could happen. And all of a sudden, we saw a spike. And to put that in perspective, we had in Q4 2025, we've been at about 3%, so about 300 basis points in terms of the 5-year bond. We dropped over the next sort of 3 or 4 months down to about 2.5, so
Wow.
16-17% decrease.
Yep.
And then in the next 4 weeks, we went back to 300 and then passed up to about 320. And as of about 15 minutes before the podcast, we were down to about 310. So again, a lot of movement. We don't seem to want to go much higher than that sort of 320, 325 right now. But by the same token, we're not exactly moving backwards and sort of picking up the lost ground. I think people are at a holding pattern, and I think that's because you hear things like, we're having good conversations and we're gonna come to an agreement, and then you hear other people saying that is in fact not the case.
Right.
But then they'll see, I think Pakistan has become involved in attempting to de-escalate. Some of the neighboring states, like the Saudis, et cetera, are also attempting to de-escalate. So it looks like there are efforts being made, but it seems like right now there's a lack of understanding of what's really happening, and that's why I don't think we're going to move one way or the other until we see something a little more decisive.
And is any of this impacting the price on the variable rate mortgages? Because I think a lot of people are tuning in because they want to kind of figure out what should they do with their renewal, or if they're looking to upgrade or purchase a place. So I've kind of noticed the pricing. So there's been some discounts on the variable rate mortgages, but I've noticed that has changed over the last couple of weeks as well. So maybe you can speak to that, how that pricing works.
We've definitely had a more pronounced sort of change on the fixed at this stage. But we have seen some movement on the variable rates, but it's been fairly minor in comparison. And a big part of that is because, to an extent, variable rates will vary. So they will ultimately adjust.
Right.
Now, if I were to put on my sort of medium to longer term range hat and look at variable rates, I might suggest that the discount may well improve if rates go higher, because typically, if you think about it, when do things go on sale? When people don't necessarily want them.
Right.
So, your overcoats and your winter galoshes go on sale in the summer because people aren't exactly beating down your door, and vice versa with regard to your swim trunks, come winter time. So right now, though, I think the market is still sort of largely digesting what's happening.
Right.
And I think that sort of is going to filter in a little bit to the third question. But right now, the impact on variable rates has been fairly minor.
Okay. And in terms of the risk that you would have with taking on a variable rate comparing to the spread with a 5-year fix, for example, like what are you kind of suggesting at this point? Because I think, again, they're looking for some form of certainty, some kind of direction. And just as a reminder, this isn't advice that's been given by Jon. This is just more of here's kind of what he sees. But obviously, you have your own individual specific situation. Reach out to Jon if you have any questions. But Jon, what are you kind of seeing right now in the current environment?
So I think there's a fork in the road,
Yep.
and a lot of it is based on, the person's feeling on what's going to happen in terms of short term. Because I would say there are two likely things to happen with regard to Iran.
Yep.
It gets wrapped up soon, or it becomes prolonged. And if that happens, either or, then it gives you, I think, a reasonably clear path in terms of what you might try to do now. I think the other component piece for Canada, and I think this is why that we had sort of generally been suggesting variable rates over the last several months, is we have some issues. economically speaking. Oil aside, some competitive issues. Our GDP is not where we would like it to be. We obviously have some structural issues with regard to how we are going to interconnect or perhaps not interconnect with the states moving forward. Our prime minister has spent a lot of time out of the country trying to, shore up existing relationships, improve others, create new ones. So I think as a result of that, the short term is the catch. What do we do if, the states decides they don't really like CUSMA anymore when they come to the renegotiation table, but, we still haven't gotten all those other things in place. Like it's hard to ignore geography.
Yeah.
And that's a big part of it. So in terms of what that means, I still feel that if you take a 5-year variable term, there's a pretty good chance that over 5 years, you're going to do better. There's a reason why variable rates sort of 85 to 90% of the time outperform fixed rates.
Right.
But it's also important to understand that at any given time, the variable might be worse.
Right.
The point I make is this. We go through the process. Iran gets sorted, whether it's in a week or a month or a year. Alternates are brought online to address supply issues. Things get figured out. Because I'll say this, people in supply chain management, et cetera, some of the most capable people in the world, like they do amazing things to move things in what is, although there's a bit of a pullback in recent years, what has largely been a very global economy. And again, they find ways.
Right.
So with the assumption that they find those ways and that, whether it's Canada picks up production or the States does or whoever it happens to be, and we start to move away from some of those other areas, what does that mean for us? Well, they'll figure it out, we'll move on. But in the short term, we may have some pain. That's where you have to be careful about falling into the trap.
Right.
Because the potential trap is that you jump at exactly the wrong time.
Mm-hmm.
And I know on the investment side, you guys have sort of similar concerns with clients where you talk about investment returns and investor returns, where people jump into the market at the wrong time and jump into the market at the wrong time.
Yeah.
So, one of the things that we try to do is we try to be aware. It's one of the reasons why I sent that missive out to my client base, just to let them know. Because ultimately, the person who's writing the check needs to feel comfortable with their choice. And I had a really interesting conversation with a gent today who is not in finance. He's in IT. And I had expected him to say, fixed rate, John, I want a fixed rate. And he, I was pleasantly surprised. He said, John, I've been doing some reading and I've been looking at the stats, and I'm a bit of a numbers guy myself, even if it's in a different field. And I see that in average, I've done pretty well by variable, even if I've had some hiccups. And I think that that's sort of where it's going to go. And again, I'm not advocating that that's the choice. Mm-hmm. But what I liked was he was educating himself, and he was putting himself in a position where whatever choice he made, he was going to be comfortable with it. Because that to me, I think more than anything else is important. Yeah. If you make the call and the call is wrong, are you going to be able to live with yourself? And that might be, you call variable rates and in the short term you see a spike, or you call fixed rates and 6 months from now rates are lower, and hopefully you're not going to be too upset with yourself. So that to me is, I think the key is, are people ultimately comfortable with the choices they make, and are they in a position where they can ultimately work through them if things don't go their way?
Right, and we always encourage people to make decisions that provides them flexibility. And I would suggest that locking yourself into a 5-year fix, just like people who invested into 5-year GICs for, there's no flexibility if things change, right? At least with the variable, you have that flexibility. Is that safe to say?
I think that's a fair point. And I mean, as I always point out, no one has ever needed my help to understand why 3% is better than 4%. Everyone kind of gets that. But policies, flexibility, what happens not so much perhaps the day I move in, but 2 years from now when the space doesn't work for me anymore, what's the exit strategy? And one of the positives about being in this field for 20 years is I've seen a few cycles, and I've been able to sort of sit back and, at times when maybe the emotion isn't sort of thick, make reasonable calls based not just on what's happening currently, but also how what currently lines up with what has happened in the past. And I think that's why, from my perspective, rather than pounding the table on one or the other, why I say a lot of it really is still, an individual decision, because I think there are good options both on fixed and variable. I think what's important is not to maybe just default to what is the most common choice. And as an example, the 5-year fixed is a great example. It's still by and large the single most selected term, in Canada. And I would say that in most situations, it's probably not the best choice because of what we just talked about.
Yeah, and I'm going to maybe make a comment, ask one final question, and then maybe Eric or Ryan have a question or two to ask. But I guess the comment that I would make is why the majority of the people select, or why the 5-year fixed is the main choice or the most popular choice is most people tend to walk into the bank, and I'm going to speak to this as a former banker, so I have experience in dealing with this. And when it comes to their mortgage, they're typically not provided advice. It's usually, here's the best 5-year fixed, or here's the best rate. It's all about the rate. And a shopper is going to sit there and say, like you said, you don't have to tell or why 3 is better than 4%, right? So a lot of people will walk into the bank, 5-year fixed, that's the rate, I'm comfortable with it, don't want to take any risks, and that's what they sign up for. They don't actually speak to the client and ask them the questions about, do you think you're going to be moving in the next 2 to 3 years? Or is there going to be any changes, any life events that you're planning for? Like, is one of the spouses going to be off from work because you're planning on having children? Like, these are questions that typically are not asked, which you do ask those questions because it's very important to understand what their plans are. And I remember there was a couple of clients where you'd say to them, what do you think the next 5 years is going to look like? Because a lot can change in 5 years. And you pointed out to the fact how you ended up having 2 boys, right? And you got married, had 2 kids, all in a 5-year span. And you need to have that flexibility. So we definitely encourage the flexibility. So that's kind of like the comment. And what I would say to people who are watching and listening, don't just, go with the best rate necessarily, because you might have these other life events that may impact that decision, which can make it very difficult for you to unwind that decision, right, financially speaking. So you need to speak with someone like Jon. And then finally, Jon, I guess the question is this. A lot of renewals, a lot of people are like, I have my renewals right now, and I'm speaking with you about looking at making some changes. I look at my phone app, and just a couple of weeks ago, guys, we recorded the gamification of, the banks and their apps and how they make things a little too easy. Right now, it's too easy for me to just say, oh, that's a good rate, click renew, and it's basically done, right? Why shouldn't they do that? Why should they at the very least speak to you before they make that decision and not just select renew and be locked in for another 5 years?
So a couple of things on that. And one, I do want to take a step back and say, I fully appreciate how important good pricing is. I fully appreciate how important it is to have a good rate. So I don't want people to think, oh, well, Jon's going to get me a lousy rate, but he's going to get me everything else. The bottom line is, I very much appreciate what my ticket to ride is, and that's good pricing. And because I do a lot of volume, I have the ability to be a little bit more aggressive with lenders than, say, an individual might. And that's not because they don't like the individual, but if the individual does $500,000 mortgage every 5 years, and I do $500 million in mortgages every 5 years, it's just the law of large averages, right? Mm-hmm. So that's item one. But, and I'll use a personal story. So my wife and I had bought our first house. We had decided that we liked the idea of trying to build an investment portfolio through real estate. This is before I moved into the business. This is going back a ways. And I went in and I sat down with my banker and I said, hey, banker, I'm buying this rental property. And my banker said, great. And I said, I really want to do this again in another year or two. And my banker said, great. And my banker said, here's the 5-year fixed term, sign off. And I said, great. And I did.
Right.
And I came back in about 18 months, like I said I would. And I had another property I wanted to buy. And I paid a massive penalty because I'd taken a 5-year term and I was breaking after a year or two, and just like I said I would. And not knowing any better, I sort of took it on the chin, and then the banker said, great, let's set up your new mortgage. And she gave me another 5-year term, and I took the 5-year term. And then in a couple more years, when I came back to buying my next rental property, I took a great big penalty again because I was breaking only a year or two into a 5-year term.
Right.
So the point I make is this: a banker is ultimately going to do what's best for the bank.
Yeah.
They can, put themselves out there as someone who is on your side, and I appreciate that. And maybe if it comes to, figuring out why a check bounced when it shouldn't have, or if it comes to sort of, getting a client service matter issued, they might try and help out. But at the end of the day, they work for the bank, and in the tug of war between you and them, the bank is going to win. From my perspective, if we don't like what TD has to offer, we can go to BMO. If we don't like what BMO has to offer, we can go to Merrick's. We have options.
Yeah.
And at the end of the day, what I hope that conveys to my clients is this is much less about sales, because as you can appreciate, if you walk into TD and you give them all your information, and the fellow at TD goes, wow, this would be a great mortgage for RBC.
Right.
Who thinks your TD person is going to send you to RBC? It's not going to happen, right? It's just not.
Yep.
But I would like to think that if you came to me and you're like, hey, I bank at BMO, what do you think about BMO? And I looked at everything, gosh, you know what, Scotia might be a better choice.
Right.
That's consulting. And it's because we have some of those options. I think that's an important difference. And again, it also doesn't hurt that I like what I do. I enjoy it. To me, it's a bit of a fun thing to try and sort of take all the component pieces and make them work. And I think, I may have a few clients who are listening today who can probably, attest to the fact that I have done, all kinds of fun spreadsheets and tables and things that, gets to the point where I have to sort of self-censor, because I'm like, if I sent them everything I did, they won't be done reading this by the time the renewal hits. But, again, that's also a piece in the passion. And I'll sort of end on this as a competitive advantage. 20 years in, I'm not in a race to get promoted to the head office. Functionally, I guess I am the head office.
Yep.
There's a lot of corporate memory with regard to my clients and what I've done. And some of our favorite clients are the people who frankly have the least inclination and the least interest to sort of spend time on this, because the fact of the matter is, those are some of the people who I think I can help the most. So from where I sit, it's a job, but it's more than a job. And I think that's, again, something that I bring to the table. And that's why I enjoy the conversations and I enjoy sort of the problem solving, because I'm not just trying to get the next sort of promotion 6 months from now, because we've all been there. You go into the bank, you've been away for 4 weeks, you go in to do something, and it's like, oh, another new person.
Right.
And you start all over again. So that, I think, is something that also people tend to appreciate.
Yeah, we haven't heard this before, you guys.
Yeah.
I don't know if people can hear me, but
Yeah, we can hear you.
I'm going to tell my story of this is that I've been in the position where I've gone to the bank, they've done the issuing, they've done their research, and then they've come back to a situation that doesn't fit my need. And it's important for people to understand. And I'm looking at the public chat too. There's a couple questions in there which might answer this question. And this is what I appreciate about Jon, is that from our process aspect, is that we're talking to clients at a minimum yearly, usually every quarterly, if not every, like twice a year. And they, between our conversations, they understand and we understand what their goals are and objectives. And when we come to Jon, there's often a conversation that happens with me and Jon, I'm sure Jim and Jon and everybody else, is this is the client's goals. and that's where Jon really elevates above going and renewing through the bank or anywhere else. Is you have the advisor that's helping support your goals. You have Jon that understands your goals and then has a secondary conversation to make sure he's clear about what your goals are. And you've talked about rate, and I have at least 30 clients over the last 3 years that I've introduced to Jon, and those that have decided not to work with Jon, sorry, Jon, have gone off, but also over the years have also come back to say the bank didn't have my longer term objective in mind. They were singularly talking about the 5-year rate and getting me the best rate for this 5 years. So working with Jon, I've learned ask a lot of questions to make sure that he understands the full scope, whether it's, hey, if it's a 5-year, Jon's taught me a lot about, hey, a lot of people start breaking the mortgage perhaps at 3-year times because maybe the rates are different, maybe their goals are different. And Jon takes those into consideration, right? And so one of the questions is, how long ahead should I start talking about renewing? With us, it's often we're talking about that consistently. And at the 1-year point if it's a 5-year term, at about the 2-year point, I'm sometimes introducing people to Jon to say, hey, even though they have a 5-year, does 3-year make sense for them based on their goals because they've worked with the bank previously? And then as a secondary, if they have a 5-year term, I'm usually, I'd say about 8 months to 6 months because I'm constantly collecting data with clients. I'm looking at that as a starting point to say, hey, again, what are your goals? What's the long-term goal? What's the short-term goal? What is something you have maybe planned at 10 years? And taking that back to Jon and saying, hey, does that make sense for this person's situation? Versus, can I chase an extra percentage point from the bank? And that's where Jon really brings his experience that I haven't seen any bank, and for that matter, other mortgage advisors really take into consideration, because the TVH group really brings into all the factors that are coming into play with people. So that's my piece. So
well, it's more about planning, right? And that's what Jon does. That's what we all do in assisting our clients. And because of Jon's background as well, Jon, you do refer to other professionals within the TVH group team. If you've seen an opportunity, for example, clients who are trying to find a way to get into purchasing their first home and maybe their cash flow isn't quite there, there's a referral to Ryan on the cash flow side where you can help them through that process. There might be some financial planning concerns, long-term retirement concerns. That's where you'll potentially refer them over to someone like myself. So, our accountant, in-house accountant, you do help a lot of clients with rental properties and kind of building that portfolio. So we offer the accounting in-house, and obviously on the legal side, we have someone who offers the legal advice when transacting on a real estate transaction. So very much helpful from that point. But the question, Ryan, that you'd mentioned, and that comes from Mary, really, Jon, as the mortgage advisor, how far ahead of a renewal should you start talking to someone about your mortgage renewal?
I'd say there are 2 points. The first is what I would call sort of the standard 6-month check-in.
Right.
So usually we can't take steps until about 4.5 months before your renewal date.
Right.
But what I've learned is it's better to know and decide not to proceed than decide you want to proceed and not know.
Right.
And what I mean by that is, we check everything over and make sure that we're good to go. And sometimes it's as simple as reviewing your credit, and we find, there are some things on there that shouldn't be on there. Might be a mistake. Doesn't get fixed quickly, right?
Yeah.
Sometimes you've got to work with the credit bureau folks, Equifax, TransUnion, work through it. And again, am I saying that's a common scenario? No, but it happens. And, it can't hurt to be prepared. And again, 6 months, I think, is a good time to start the conversation, because it also means you're not under the gun. If I do introduce some concepts that maybe you're not familiar with, you give yourself time to educate yourself, you give yourself time to ask questions. To Ryan's point, I do like a lot of questions up front, because the reality is it's a lot easier to change things before you make a final decision than it is after you make a final decision. So that's also very useful. And then the other time when you should sort of get into it is when you have a need. So if you're 6 months in, 2 years in, maybe you've got 2.5 years to go, but you're having trouble. Maybe you've had an income interruption. Maybe you had an unforeseen expense. Maybe something has happened and you are, pressed and you're losing sleep and things aren't working the way they should. Let's look at the numbers. Can't hurt. We look at the numbers, and oftentimes there is a path forward. Sometimes there isn't, but at least you're not going to look back in 2.5 years and go, oh gosh, I've put myself through this ordeal when potentially I could have fixed it much sooner. And my point is, again, if there's a specific issue, if something has come up, ask the questions. Can't hurt to ask. You can always say, doesn't make sense to me at this point, and then just wait. But knowing sooner, to me, is usually better.
Yeah, and I think there's been some situations too, John, in the past where, because there is a bit of a crossover with some people where they've locked in at a much higher rate a few years ago, and I'll ask them the question, and Ryan, I know you do as well, in terms of when's the next renewal. They might say 2 years out, so they're going to wait, but I always encourage them to speak with you, because sometimes based on what they're paying over the next 2 years to what they could potentially get now, and even with the penalty, there would be some significant interest savings as well, right? So there are those situations where we do suggest to people, you might want to do this sooner rather than later.
Well, we run the numbers. You've got a $500,000 mortgage, but you've got $100,000 in, car loan, credit card, et cetera, that are maybe at higher rates.
Yep.
Just run the numbers. It can't hurt. You can see if they, look better to you, then that might be an option. If it makes more sense to wait, then at least you'll know.
All right. Okay.
Yeah, John, I've got a hypothetical. Yeah, so I've seen this a few times over the course of my career. What would happen? Say I barely qualified for my mortgage, or got a mortgage that was, almost fully extending what I could afford. And then now we see a potential for a rise in interest rates that could also then cascade into, more supply than demand in the house sales. So maybe my house price drops a little. Say I'm on the edge of qualifying, or now below what I would have to qualify if I was going to renew. What are my options as a mortgagee, and how do you solve that as an expert in helping someone who's in that situation?
Well, the reality is, different lenders have different policies. And just because something doesn't work at one lender doesn't mean it won't work at others. Now, the reality is sometimes you may be in a position where your situation becomes untenable. But again, my experience is knowing things like that sooner is typically better than knowing later. The analogy I tend to use is, it's like turning a big ocean liner. You see the problem several miles away, you make a small course correction, you can ultimately miss the issue. If you don't see it until it's too late, then it doesn't matter what you do, you're stuck. So my usual suggestion is try to get out ahead of these things. And if you're seeing something or you're feeling something and it doesn't seem right, it can't hurt to check in.
Yeah.
So guys, we're almost at the 1 hour mark. Eric or Ryan, do you have any other questions or comments before we start to close off?
Oh, I'm sure lots of people have more questions, but as far as the cash flow side of things is, Jim, you and I have talked for almost 2 years now about course correction and cash flow, right? And anticipating what's going on right now with the increased mortgage rates, right? And I guess it's almost like the Titanic effect. You know, you can course correct a little bit and still hit the iceberg, but
Right.
if you're far enough back, you have a better option. But also at the same time, had the Titanic hit the iceberg head on, it might have survived, which means let's talk about those conversations right now and hit them head on, and let's make sure that we don't necessarily have to course correct fully, but also that you have all the answers and you have the iceberg in view to make sure that you're making the right decisions, whether it's, hey, let's hit it straight on, let's survive this and have the right conversations, or that you have a long enough time that course correct to make sure that you're working with a team like TVH and TVH Mortgages to make sure that we're making the right decisions, whether it's your 3 years out from your mortgage renewal, you're 6 months out from your mortgage renewal, that we're having that dialogue. What does the cash flow feel like? And also at the same time, taking into consideration all the things that John and his team needs to do to make sure that you don't, sink. So,
Right. Awesome. Eric, do you have any comments or questions?
Yeah, the only thing I'll add is to back up Ryan's comment. Like, there's 1,000 scenarios, probably 1,000,000 scenarios. The easiest thing to do is just to reach out and say, "Hey, this is my situation. Is there anything I have to consider?" And if there is, you'll figure it out. And if there's not, that's great. It's maybe 15 or 20 minutes in a conversation. But 99% of the time, the problems can be figured out just by a simple phone call. Chat through it, make sure you've got everything taken care of, and then you're in good shape.
And speaking of which, John, so if anyone does have any follow-up questions, they would like for you to take a look at their current mortgage situation, what's the best way to reach out to you?
Email or phone. You can dial me at 647-801-5363. That's 647-801-5363, or jon@tvhgroup.ca. And I'm sure if you typed in TVH Group on the internet, at some point I would pop up in your feed.
Yeah, and just to remind everyone, within TVH Group, again, obviously we have the mortgage solutions that are offered through John, legal offered through our partner Sonia, accounting offered through our partner David, the financial planning side of things offered through me, cash flow coaching through Ryan, private alternative investments offered through Eric, and Denis, who's not here, who also offers our in-house portfolio management solution. So we are considered a family office. So if you're looking for some additional assistance, I think we have another comment here. We received a thanks. Jason, you're welcome. You've been a long time client of ours, and really appreciate working with you. But yeah, also, if you do want to reach out to us, as John mentioned, tvhgroup.ca, you'll find all the services listed there on our website. There is a chat feature there. You can also contact us directly through there, and from our social media platforms. So we're on TikTok, Instagram, LinkedIn, Facebook, Twitter. Did I miss any, guys? I think I got them all right. So we're on all those platforms. Yeah. So YouTube, obviously, podcast. So we will be sending this out by the end of this week as well as a blog post, and it will go on our podcast and on our YouTube channel. So, John, thank you very much for your time. Really appreciate it. I know it's been an interesting few months now in the market, and I'm sure it's going to continue on being an exciting time for all of us. Ryan, Eric, thanks again. And just finally, I believe, Eric, we're going to have a recording. Well, actually, Ryan, we have your guest on the 13th, Dr. Travis Perry, correct? And what are we going to be talking about during that session?
Mindset, especially when it comes to couples and their managing money within with couples. So that's a big thing on my side. So
All right, so that's love and marriage is basically we're gonna,
yeah.
so that'll be April.
Married with Children. Yes,
Yeah.
the Married with Children episode. Yeah.
Right. So that'll be April the 13th. So we will send out the webinar invitation for that as well. And then Eric, you and I are working on bringing on a couple of issuers on the private side. So I think we're probably going to be recording 4 weeks straight, starting April the 13th. Correct?
Yeah, I'm excited for those ones. Yeah.
Awesome. All right, guys. Thanks again. Have a wonderful afternoon.